So you want to know why this strategy works? Let me read you something real quick. So you know how we've seen investment. Actually, you know what? Let me just show you. Let me just show you. Let me just show you. So we have, this is, Vanguard's 9,000 position ETF. That's another story. So if we look at GameStop's 13F, what do you notice? You scroll down through here and you see New York State Retirement System, State of Michigan Retirement System, J&L Series Trust, Vanguard Variable Insurance Company, um, you know, share lending vehicles by definition. You see buying and selling of institutions. You see hedging from market makers. You see ETFs in large buying up the stock. Every time you see the word or the letters NP, that stands for import, which is a ETF reporting document. You have the Vanguard Explorer Fund, Sun America Series Trust. You notice that there's a lot of buying and selling, hedging, and there's a lot of share lending going on. Well, that's because, and a lot of shorting apparently. That's because they're controlling the stock. They always have. Because crime. Now, what do we know about the repo market? It's crime. Again, right? Crime's everywhere. But that's the thing I've been looking at all year last year, and that is exactly where the money is able to be made right now. Not in this shit. Not right now. Well, that's later, when Ryan Cohen said so, when he thinks, later in 2023 is going to come to fruition. So I'd probably listen to the CEO of the company, or not the CEO, but the chairman, about what he said. Now, could that mean it could be earlier? Of course. Could it be later? Of course. We don't really know until the company comes out and says something. And we won't know that for sure unless it's from the company itself, not Wall Street Journal. So anyways, what do we know about the repo? It's a vacuum cleaner. They run to the Fed with a bunch of cash and they buy up Treasury securities in part, and they hold them overnight and then return them the next day for a small interest. Now, if you look at the Fed's own words, I'm going to read this to you. We've seen insurance companies, pension funds, all that in GameStop. Now listen. Investment portfolios of insurance companies and endowments established by educational institutions often hold securities that can be used as collateral to obtain cash in the repo market. Cash can be reinvested to deliver incremental return on a portfolio of securities. Beginning in 2015, a small number of insurance companies and educational institutions established direct repo trading, bypassing dealers. These so-called direct repo trades could offer some advantages, including more flexible terms and potentially better pricing for both sides in the absence of an intermediary. However, this type of repo is often less operationally efficient, which limited its growth. On average, direct repo only accounts for around 0.1% of the total MMF repo investments. So, small demand, but again, it is a number. It is a factor. Now, let's look at MMF repo collateral. MMFs accept a broad range of securities with varying maturities as repo collateral. Historically, government securities have accounted for the great majority of MMF repo collateral. As of December 31st, 2020, around 64% of MMF repo investments, and MMF stands for money market fund, were collateralized by Treasury securities, and around 31% were collateralized around government securities, including mortgage-backed and asset-backed. Now, it says right here, under 5% of MMF repos were collateralized by other types of securities, including corporate bonds, equities, and asset-backed securities. Among all MMF types, prime money market funds are the main investors in repos backed by non-government securities. So we can take that info, the prime info. We can take this info. We can go here now to the OFR, Office of Financial Research. We can go to the prime money market funds that we just saw has non-cash collateral. Let's take a look and see what's going on. What kind of stuff are we doing here? Let's look at USA and drill down into the government financial institution. This is what you want. This is the repos you want. The financial institutions and the other. We're going to look at other as well, but boom, there's all our big friends, right? JP Morgan, who's their fund managers here. It's so laggy. Okay, Fidelity, always number one, right? So anyways, this is how you check this stuff. This is how you check the other side of it. Now, let's go to Vanguard. Actually, let's do this. Let's go to the top. Let's just start over. Let's go to Prime MMFs. And we're going to look at MMF repos with the Fed Reserve. we're going to look at Vanguard. We're going to drill down on the fund manager to find the individual fund name. Now look, if we go back to the total Vanguard World Stock ETF, right here, import, that's what I was talking about earlier. One of their biggest holdings in there is obviously going to be that liquidity fund that you see. Come on. 9,000 holdings. Right there. Vanguard Market Liquidity Fund. So you see that, then you go back here, and that's the fund. Vanguard Market Liquidity Fund. 53.8 billion was the highest point of the year. So if we know that in the repo market, cash is swapped for collateral, and there's 5% of demand as of last year, I guarantee you that's higher now. If there's at least 5% of demand being in non-government securities as collateral, what does that mean? It means they have positions that are immobilized because they have to be used as cash collateral. So why do you think there is, I made this up, this is a list of over 800 different companies with over 90% institutional ownership. Remember what happened last year in February when GameStop was at 200% institutional ownership? Yeah, popped, right? What do you think is going to happen here when they have to unwind all this repo collateral? Because that's exactly what this stuff is. I can prove it. So, and by the way, it's not collateral in the way you think. It's synthetic ETFs. Now hear this out. ETFs are pooled investment vehicles that, unlike mutual funds, are listed on an exchange and can be traded intradaily. ETFs normally track a benchmark index and can be classified as physical or synthetic ETFs depending on how they replicate their benchmark. Physical ETFs can purchase the same securities that are included in the benchmark or can replicate the benchmark according to statistical techniques that allow to purchase and trade fewer and more liquid securities. It's all about liquidity. Synthetic ETFs do not hold securities, but enter a total return swap with financial institutions that promises to pay the return of the benchmark to the ETF. The swap is collateralized with a portfolio of securities, which is exactly what I've been talking about. The swap is collateralized with a portfolio of securities to which the ETF has access to in case the swap counterparty defaulted on its obligations. So, now let's go to the Fed website. The Fed themselves. We're going to read something real quick. Leveraged ETFs, equity, fixed income, commodity, alternative, and currency, they're all 100%, 25%. It's all 100%. Normal ETFs, not so much. But I want you to read this paragraph right here. The ETF issuer uses the investor's cash to buy a basket of securities. Substitute basket or collateral basket from the swap counterparty, which promises to deliver the return of the reference index minus a swap fee if applicable, and in exchange, the swap counterparty receives the return generated by the substitute basket. Under this structure, the ETF issuer owns the assets in the substitute basket and can immediately liquidate them if the swap party defaults. Then you see Supernote 2. What does Supernote 2 say? Supernote 2 says, some providers may decide to invest the money with the swap counterparty in a reverse repo. Well, that's the Fed. So if it's all clicking, it did with me. The Fed's central counterparty for the repo. All of these securities are bought up by institutions because they're being used as collateral, and it's only the big players, only the biggest players. What are we waiting on to come out? The SFT service, right? Well, if you remember anything about what I read about the NSFR ratio last year, there's this thing. It's called encumbered assets. Encumbered assets. This is the SFT literal blueprint right here. And this document, I'm going to link it below so you can read it. It's called The Ins and Outs of Collateral Reuse. By the way, this was written in 2018, and it talks about the SFT service about to come out. Look at this. So, an encumbered asset is one that's been rehypothecated. An unencumbered asset has not been rehypothecated. So what do you think they're planning on doing here? If we have a bunch of synthetic ETFs in the repo, what do you think is going to happen? Why are they separating non-rehypothecated and rehypothecated in the SFT? Because anything blue here is SFT. The reason is, remember, 2 in, 1 out? 1 rehypothecated is going to go in, 1 non-rehypothecated is going to go in, and then 1 real one's going to come out. And they're going to finance the debt and the likely execution of the small and medium players in the repo. Or not the repo, but the market in general. So they're planning on some big transfer of money, but no one's looking. So come look.